Before we begin, it's crucial to state that the information in this video is for educational and informational purposes only. I am not a licensed financial advisor, mortgage broker, or real estate agent. The world of mortgages is complex and constantly changing. You should always consult with qualified professionals, like a mortgage lender and a real estate agent, to understand your specific situation and get advice tailored to your personal financial circumstances. This presentation is not financial advice, and any decision you make is solely your responsibility. I want you to picture this. It's late. You should be sleeping, but instead you're scrolling. You're on Zillow or Redfin or Realtor.com, and you're doing that thing we all do. You're dreaming. You swipe past a few duds and then you see it. It's not a mansion, but it's perfect. It has that extra room you could use as an office, a backyard big enough for a dog, and a kitchen that doesn't look like a time capsule from 1983. A genuine smile spreads across your face. You can see yourself there. You can almost smell the coffee brewing in that kitchen on a Saturday morning. And then you do the math. You scroll down past the beautiful photos to that one little section, the estimated monthly payment. Your eyes scan past the principal and interest, the taxes, the insurance, and then they land on it. The down payment. That one single massive number. And just like that, the dream evaporates. That number feels less like a goal and more like a giant concrete wall standing between you and the front door of that home. Feels impossible. Unreachable. A finish line that keeps moving further away the faster you run. What if I told you that wall is an illusion? What if I told you the single biggest barrier to homeownership for millions of Americans, the down payment, is something you might be able to legally and ethically sidestep entirely? That's not clickbait. That's a fact. The idea that you absolutely need 20% down or 10%, or even 5% down to buy a home in the United States is one of the most persistent and damaging myths in personal finance. And over the course of this series, we are going to systematically dismantle that myth piece by piece. We are going to give you the blueprint, the exact government-backed programs and little-known loan options that could allow you to walk into a home of your own with $0 down. Let's start by attacking the biggest monster in the room, the 20% myth. Where did this even come from? Why does your uncle, your boss, and every other person with an opinion insist that you need 20% down? It's not a law. It's not a rule written in stone. It's simply the threshold at which lenders are not required to make you pay something called private mortgage insurance, or PMI. PMI is basically an insurance policy that you, the buyer, pay for, but it protects the lender. Protects them in case you default on your loan. If you put down 20%, the lender sees you as less of a risk. You have significant skin in the game. You have instant equity, so they waive the PMI requirement. But let's be crystal clear. Avoiding PMI is a financial strategy, not a requirement for entry. Saying you need 20% down to buy a house is like saying you need to buy a car with cash to avoid having a car payment. It's a nice goal, but it's not the only way to get the keys. Millions of people get car loans every day, and millions of people buy homes with less than 20% down every single year. They just pay that extra PMI fee for a while, which on average might be $50 to $150 a month for every $100,000 borrowed. It's a cost, yes, but is that cost worth getting into a home now, instead of waiting 5 or 10 more years to save a massive pile of cash while home prices and rents continue to climb? For many, the answer is a resounding yes. So, if 20% is a myth, what's the reality? The reality is that the down payment serves one primary purpose for a lender. It reduces their risk. When you put your own money into the deal, you're financially invested. You're less likely to walk away if things get tough. It also creates an immediate equity cushion. If you buy a $300,000 house and put $30,000 down, the lender is only on the hook for $270,000. If the market dips slightly and you have to sell, they're still likely to get their money back. This is the entire game. The whole mortgage process is a dance between you proving you're a reliable borrower and the lender deciding how much risk they're willing to take on. The down payment has traditionally been the easiest way to prove it. It's a big, loud, flashing sign that says, "I'm serious and I have financial discipline." But, and this is the key to everything we're going to talk about, it is not the only way. What if there were programs specifically designed to tell the lender, "Hey, this person is a good bet, even without a down payment. We'll back them up"? What if the government itself was willing to step in and essentially co-sign for you, telling the bank, "Don't worry, we've got your back on this one. Give them the loan"? That is precisely what a no down payment mortgage is. It's not a magic trick or a sketchy back alley deal. These are established, legitimate, and often government-guaranteed loan programs designed to open the doors of homeownership to people who have good credit and stable income, but haven't had the opportunity to save up a small fortune for a down payment. And these programs are hiding in plain sight. We're talking about options for specific groups of people and even specific locations. For example, if you are a veteran and active duty service member or a surviving spouse, there is a program that is, without question, the single best mortgage product in America, and its primary feature is a 0% down payment requirement. If you're looking to buy a home outside of a major metropolitan hub, and you'd be shocked at what qualifies as rural, there's another government-backed program that allows for 100% financing. We're talking about suburbs, small towns, and communities just a short drive from major cities that you would never think qualify, but they do. There are even options in the conventional loan world. Programs created by Fannie Mae and Freddie Mac, designed for first-time homebuyers or those with lower incomes, that require as little as 3% down. And then we have the secret weapon, down payment assistance programs. These are grants and secondary loans from state and local governments that can be layered on top of your main mortgage to cover your down payment and sometimes even your closing costs. The result? You could walk to the closing table and pay next to nothing out of your own pocket. This is for the teacher with a steady paycheck but student loan debt. It's for the young family with good income but who sees every spare dollar eaten up by skyrocketing rent and daycare costs. It's for the military veteran who has served our country and earned this benefit. It's for anyone who has felt that crushing disappointment of seeing their savings get outpaced by a housing market that seems to be running away from them. Now, I have to be brutally honest here. No down payment does not mean no cost. This isn't free money. You will still have to pay for things like the home appraisal, the inspection, and a collection of fees known as closing costs. These can add up to thousands of dollars. But tackling a $5,000 or $10,000 closing cost bill is a completely different universe of difficulty than trying to save up $30,000, $40,000, or $50,000 for a down payment. We're turning an impossible mountain into a manageable hill. So the question is no longer, can I buy a house with no money down? The question you should be asking is, which of these incredible options is the right one for me? That's the journey we are starting today. We're going to break down each path. We'll explore the pros, the cons, the eligibility requirements, and the fine print for each one. We will arm you with the knowledge you need to walk into a lender's office with confidence, not desperation. The dream you had while scrolling on your phone late at night doesn't have to be a dream. It's time to turn it into a plan. So let's start building that plan piece by piece. The first step is to understand the most powerful tools at your disposal. When it comes to buying a home with no money down, the United States government is surprisingly your greatest ally. It backs several loan programs designed specifically to help people break into the housing market. And today we're going to focus on the two heavyweights, the two most common and powerful zero down payment options available: the VA loan and the USDA loan. These aren't obscure loopholes or gimmicks. They are robust, established programs that have helped millions of American families turn the key in the door of their very own home. We'll start with what is arguably the most impressive mortgage product in the entire country: the VA loan. To understand the power of the VA loan, you first have to understand its soul, its purpose. This isn't just a financial program. It's a promise. It's a thank you written into federal law for those who have worn the uniform of the United States military. Its roots go back to the original GI Bill in 1944, a landmark piece of legislation designed to help returning World War II veterans readjust to civilian life. The government recognized that these men and women, who had sacrificed years of their lives, were coming home at a disadvantage. They hadn't been building careers, saving money, or establishing credit in the same way as their civilian counterparts. The GI Bill and the VA home loan guarantee it created was designed to level the playing field. It was a way of saying, "You fought for our home, now let us help you get your own." And that promise is still alive and stronger than ever today. So, who is this incredible benefit for? The eligibility is specific, but it covers a wide range of individuals connected to the military. It's for veterans, of course. It's for active duty service members who have served for a certain period of time. It's for members of the National Guard and Reserve with 6 years of service. It also extends to certain surviving spouses of service members who died in the line of duty or from a service-related disability. If you think you might fall into one of these categories, the first concrete step you need to take is to get your Certificate of Eligibility, or COE. Now, that sounds like a complicated piece of government paperwork, but it's usually a straightforward process that a good lender who specializes in VA loans can help you get in minutes. The COE is your golden ticket. It's the official document that proves to the lender that you have earned the VA home loan benefit. Once you have that ticket, a whole new world of possibilities opens up. And this is where it gets truly exciting. Let's talk about the 4 superpowers of the VA loan. The first and the most famous is the zero down payment. This is the game changer. Let's put this in real numbers. On a $350,000 home, a conventional loan might require a 5% down payment. That's $17,500. An FHA loan, another government-backed option, requires at least 3.5% down. That's $12,250. For many people, saving that kind of cash is the single biggest barrier to homeownership. It can take years, even a decade, of disciplined saving. The VA loan completely removes that barrier. You can finance 100% of the home's purchase price. This means your primary upfront costs are closing costs, which are a fraction of what a down payment would be. The second superpower, and this one is almost as important as the first, is no private mortgage insurance. No PMI. This is a term you absolutely must understand. When you put less than 20% down on a conventional loan, the lender sees you as a higher risk. To protect themselves in case you default, they force you to pay for an insurance policy. That's PMI. But here's the kicker. That insurance doesn't protect you. Protects the bank. And you're the one paying for it every single month, rolled right into your mortgage payment. It can add hundreds of dollars to your monthly bill. For example, on that same $350,000 house, PMI could easily cost you an extra $150 to $250 per month. That's thousands of dollars a year that isn't going towards your principal, isn't building you equity, it's just gone. The VA loan eliminates this. Because the Department of Veterans Affairs guarantees a portion of the loan for the lender doesn't need that extra insurance. There is no PMI. Ever. This single feature makes the monthly payment on a VA loan significantly more affordable than other low down payment options. The third superpower is competitive interest rates. The VA doesn't set the interest rates, private lenders do. But because the government is guaranteeing a piece of the loan, lenders see it as a very safe bet. Less risk for them often translates into a lower interest rate for you. Over the 30-year life of a loan, even a 0.25% difference in your interest rate can save you tens of thousands of dollars. And the fourth superpower is that the VA limits the closing costs that lenders can charge. The VA has a list of what they call non-allowable fees, which are costs that the veteran is not permitted to pay. This is another layer of protection, ensuring that you're not getting nickel and dimed at the closing table. So you're probably thinking, this sounds too good to be true. What's the catch? It's a fair question, and transparency is key. There is one significant cost associated with most VA loans: the VA funding fee. This is a one-time fee paid directly to the Department of Veterans Affairs, and its purpose is to keep the loan program running for future generations of service members and veterans, without costing the U.S. taxpayer anything. The fee is a percentage of the loan amount, and it varies depending on your service, your down payment amount, and whether it's your first time using the benefit. For a first-time user with zero down, it's typically 2.3% of the loan amount. Now that sounds like a lot, but here's the critical part. For most borrowers, it can be rolled into the total loan amount. You don't have to pay it out of pocket. And, very importantly, some veterans are exempt from the fee entirely, most notably veterans receiving VA disability compensation. Let's bust a couple of myths while we're here. You might hear that sellers don't like VA loan offers, or that they're slow to close. Decades ago, there might have been some truth to that. But today, with modern technology and experienced lenders, a VA loan can close just as quickly and smoothly as any other type of loan. A good real estate agent knows how to present a VA offer as what it truly is: an offer from a highly qualified, pre-approved buyer with a secure government-backed loan. Imagine a veteran named Mark. He's been renting for 10 years, watching his rent go up every single year. He has a good job, but with student loans and the cost of living, he's only managed to save about $8,000. He scrolls through home listings at night, but every time he uses a mortgage calculator, the down payment number makes him feel defeated. He assumes he's at least 5 years away from even thinking about buying. Then a buddy from his unit tells him to look into his VA loan benefit. Mark is skeptical. He thinks it'll be a bureaucratic nightmare. But he makes a call. The loan officer tells him that not only can he buy a home with zero down, but without a PMI payment, his monthly mortgage on a home of his own could be very close to what he's currently paying in rent. Suddenly, the impossible feels possible. His $8,000 in savings, which he thought was just a start, is now more than enough to cover his closing costs. 6 weeks later, he's not scrolling through listings anymore. He's standing on the porch of his own house, a house he thought was years away. That is the power of this program. It's a tangible benefit, earned through service, that can fundamentally change the course of your financial life. If you have ever worn the uniform, or you are the surviving spouse of someone who has, you owe it to yourself to investigate this. It is, without a doubt, one of the most valuable benefits you have earned. But what about everyone else? What about the teachers, the firefighters, the nurses, the truck drivers, the millions of hardworking Americans who didn't serve in the military? Is there a zero-down option for them? The answer is yes. But it isn't found in the bustling heart of a major city. It's found somewhere a little quieter, a little more spread out. What if I told you that the US government has another powerful zero-down loan program, and its main requirement has nothing to do with your profession, and everything to do with geography? We're about to explore the surprising and often misunderstood world of the USDA loan. And you might be shocked to find out that the home of your dreams could be in an area that qualifies. So let's talk about the USDA loan. When you hear the letters USDA, what's the first thing that comes to mind? For most people, it's the stamp on a package of steak. The United States Department of Agriculture. And because of that, a huge myth has grown around their home loan program. People assume it's exclusively for farmers. They picture someone on a John Deere tractor, buying a farmhouse with a red barn, surrounded by 100 acres of corn. And while a farmer could certainly use this loan, thinking it's only for them is one of the biggest and most costly misconceptions in the entire world of real estate. The truth is, the USDA loan program isn't about your profession at all. It's about promoting prosperity in less populated parts of the country. The official name is the Single Family Housing Guaranteed Loan Program, and its goal is simple: to help build and strengthen communities outside of major metropolitan centers. Think about it from the government's perspective. They want to encourage people to move to and invest in these areas to stabilize local economies, support schools, and create a more balanced population distribution. And the way they do that is by offering one of the most incredible mortgage products on the planet: a true 100% zero down payment mortgage. Let's break down the 3 monumental advantages of a USDA loan. First, and most obviously, is the zero down payment. This is the holy grail. While your friends are scraping together 20%, or even the 3.5% for an FHA loan, you can walk into a home with literally nothing down. On a $300,000 home, that's the difference between needing to write a check for $10, $20, or even $60,000 and needing zero. It completely changes the timeline for homeownership, accelerating it by years for the average person. Second, the interest rates are often lower than conventional loans. Why? Because the USDA guarantees a portion of the loan for the lender. From the bank's point of view, this makes the loan far less risky. If for some reason the borrower defaults, the government has their back. Less risk for the lender means a better interest rate for you. Over the life of a 30-year mortgage, even a fraction of a percentage point lower can save you tens of thousands of dollars in interest. And third, and this is a big one people often overlook, is the reduced mortgage insurance. Now, if you're not putting 20% down on a conventional loan, you're usually required to pay something called private mortgage insurance, or PMI. It's insurance that protects the lender, not you, and it can add a significant amount to your monthly payment. USDA loans don't have PMI. Instead, they have a similar structure with 2 parts: an upfront guarantee fee, that's usually rolled into the total loan amount, and an annual fee that's paid monthly. Here's the key. The USDA's annual fee is almost always significantly cheaper than the PMI on a conventional loan or the MIP on an FHA loan. For example, the USDA's annual fee is currently 0.35% of the loan balance. On an FHA loan, it's often 0.85%. On that same $300,000 house, that's the difference between paying roughly $87 a month with USDA versus over $212 a month with FHA. That's more than $125 back in your pocket every single month for years. So zero down, lower interest rates, and cheaper mortgage insurance. Sounds almost too good to be true. So what's the catch? Well, it's not a catch so much as it is a set of very specific eligibility requirements. And they fall into 2 main categories: the property and the person. First, the property. The home you want to buy must be located in an eligible rural area as defined by the USDA. And this is where we have to destroy that farmer myth once and for all. The USDA's definition of rural is incredibly broad. It includes small towns, suburbs, and exurbs all across the country. In fact, A staggering 97% of the landmass of the United States is located in a USDA-eligible zone. You would be absolutely shocked to see the maps. We're talking about beautiful suburban neighborhoods with great schools, just a 30 or 40-minute drive from the downtown of a major city. The USDA has an official eligibility map on their website. You can literally type in an address of a home you're interested in, and it will tell you instantly if it qualifies. Many people who are house hunting just assume they live in an ineligible area. They don't even check. But spending 5 minutes on that website could be the difference between needing to save for 5 more years and being able to buy a home right now. The property itself must also be your primary residence. No vacation homes or investment properties, and it needs to meet basic standards for being safe and sanitary. The second category of eligibility is you, the borrower. This is where the USDA program differs greatly from the VA loan we talked about. This program is designed for low to moderate income households. That's right, you can actually make too much money to qualify for a USDA loan. The income limits vary widely depending on where you live and how many people are in your household. A 2-person household in a low cost of living county in Alabama will have a very different income limit than a 6-person household in a high-cost county in California. Again, the USDA website has a tool where you can input your location and household details to see the exact income limit for your area. The goal is to help people who have stable jobs and decent credit, but who haven't been able to save up a large down payment. Speaking of credit, while the USDA itself doesn't set a hard minimum credit score, the private lenders who actually issue the loans do. Generally, you'll find that a credit score of 640 or higher will give you the best chance at getting approved through their automated underwriting system. It is possible to get approved with a lower score through manual underwriting, but it's a higher bar to clear. You'll need to show what's called a willingness to meet credit obligations, with things like a solid history of paying your rent on time and no major credit issues in the past 12 months. Finally, it's worth knowing there are actually 2 different types of USDA single-family housing loans. The one we've been discussing, the one most people get, is the guaranteed loan. This is where a private lender like a bank or a credit union gives you the mortgage, and the USDA simply guarantees it. This is for borrowers with moderate income. But there is also the direct loan. This is for low and very low-income applicants. With a direct loan, the USDA is your lender. The money comes directly from the government. The income limits are much lower, but the benefits can be even greater, sometimes including payment assistance that can temporarily reduce your mortgage payment to as low as a 1% interest rate. It's a bit more difficult to qualify for, but for those who do, it can be a life-changing program. So, to recap the USDA loan, it is not just for farmers. It is a powerful zero-down payment option for anyone looking to buy a primary residence in a designated rural or suburban area, as long as their household income falls below the local limit. It offers competitive rates and lower monthly costs thanks to reduced mortgage insurance. But what if you check the map and the home you want is just outside the eligible zone? What if your income is just a little too high to qualify? Are you just stuck, doomed to save for years to come? Not necessarily, because there's another path to a zero-down reality, one that works with many different types of loans. It's a strategy that hinges on understanding the surprisingly flexible rules around where your down payment money can come from. What if I told you that you didn't have to save a single penny of it yourself? We're about to dive into the world of down payment assistance programs and gift funds, and how they can bridge the gap to get you in a home with zero of your own money out of pocket. Think of the down payment as the final boss in the video game of buying a house. You've battled your credit score, you've leveled up your income, but this one giant obstacle stands between you and the keys to your kingdom. And for most people, it feels impossible. But what if I told you there's a secret cheat code? A hidden power-up that gives you the exact amount you need to win? That's what down payment assistance, or DPA, is. It's not a handout. It's a strategic investment made by state and local governments, housing finance agencies, and even nonprofits. Why do they do this? Because homeowners build stable communities. They pay property taxes, they support local businesses, they put down roots. So these organizations have a vested interest in helping you get over that final hurdle. They're essentially betting on you and in turn betting on the success of their own community. Now, this assistance doesn't just come in one flavor. It's a whole menu of options, and the first one is the one everyone dreams about, the grant. A grant is the holy grail of down payment assistance. It is, in the simplest terms, free money. It's a gift that you never ever have to pay back. Let me say that again so it sinks in. You are given thousands, sometimes tens of thousands of dollars to put towards your home purchase, and you owe nothing in return. It's not a loan. There's no interest. It's a straight-up cash injection into your home buying journey. Imagine you're trying to buy a $300,000 house. A standard FHA loan requires 3.5% down, which is $10,500. A DPA grant could come in and hand you that entire amount. Suddenly, the biggest financial barrier in your life just evaporates. Of course, because this is literally free money, grants are the most sought after and often have the strictest requirements like income limits or being a first-time homebuyer, but they absolutely exist and people get them every single day. Okay, so what if a grant isn't available in your area, or you don't quite qualify? Don't worry, the next option is just as magical and in some ways even more common. It's called a forgivable second mortgage. This sounds complicated, but the concept is beautifully simple. An organization gives you the money for your down payment, say $15,000, in the form of a loan. This loan sits behind your main mortgage like a silent sleeping partner. It has a 0% interest rate and requires 0 monthly payments. Now here's the magic trick. The loan is attached to a forgiveness clause. Typically, it works like this. For every year you live in the home as your primary residence, a portion of that loan is forgiven. So, if it's a 5-year forgiveness period on that $15,000 loan, after your first year, $3,000 disappears. Poof! After year 2, another $3,000 is gone. You live in the house for the full 5 years, and the entire $15,000 debt is completely wiped off the books. It vanishes as if it never existed. You effectively got a free down payment, you just had to promise to actually live in the house for a little while, which of course was your plan all along. It's an incredible tool that rewards you for being a stable homeowner. But let's keep going down the list. The third major type of DPA is a repayable second mortgage. Now I know what you're thinking. Another loan? Isn't the whole point to avoid more debt? Hear me out. These are not your typical loans. They are designed to be incredibly gentle and affordable. Often they carry a 0% or a very, very low interest rate, far lower than any personal loan or credit card you could ever get. The repayment terms are also incredibly flexible. Some of these loans are deferred, meaning you don't have to pay a single penny back on them until you sell the house, refinance, or pay off your main mortgage, potentially 30 years down the line. Imagine getting an interest-free loan for $10,000 that you don't have to think about for decades. By the time you do have to pay it back, the value of your home has likely appreciated so much that you can pay it off with a tiny sliver of your profits. Other repayable loans have very small monthly payments that are added to your main mortgage payment. We're talking maybe $25 to $50 a month. It's a tiny, manageable amount that makes the impossible, coming up with thousands of dollars at once, suddenly possible. So you have grants, forgivable loans, and gentle repayable loans. That's a powerful arsenal. But there's another path, a completely separate route that can be used alongside a zero-down mortgage, or even in combination with DPA. And that is the power of gift funds. This is one of the most misunderstood aspects of buying a home. Lenders need to see that the money you're using for your purchase is yours, and isn't some secret, undisclosed loan that will affect your ability to pay your mortgage. So, if your parents or a close relative want to help you out, you can't just have them Venmo you $20,000 the day before closing. That will raise a massive red flag. The lender needs proof that this money is a true gift, not a loan in disguise. This is where the almighty gift letter comes in. It is a simple one-page document that is absolutely critical. Your family member, the donor, writes a letter that explicitly states a few key things: their name and relationship to you, the exact dollar amount of the gift, and the most important sentence of all: this is a bona fide gift, and there is no expectation of repayment, expressed or implied. That last phrase is pure gold to a mortgage underwriter. Along with this letter, you'll need to show the paper trail, the money leaving the donor's account and entering your account. This clean, documented process tells the lender that your financial foundation is solid, and that you don't have a secret side debt they need to worry about. Most loan programs, like FHA and conventional loans, allow 100% of your down payment and even your closing costs to come from gift funds from an approved donor, usually a family member, but sometimes a fiancé or domestic partner. So if you're lucky enough to have family who can help, this is your ticket to getting into a home with zero of your own savings. Now, here is where we start to bend the rules of reality. This is the masterclass level. What happens when you combine these strategies? Let's say you qualify for a VA loan or a USDA loan, which, as we discussed, require no down payment at all. You're already in the game. But what about closing costs? Those pesky fees for appraisals, title insurance, and loan origination that can still add up to thousands of dollars. Well, this is where you can stack your power-ups. You could use a DPA grant or a forgivable loan specifically to pay for your closing costs. Think about that. You have a zero-down mortgage, and then a government agency comes in and gives you a grant to pay all your closing costs. The amount of money you need to bring to the closing table could be literally $0. Or you could use gift funds from a family member to cover those closing costs. Either way, you are walking into a home that you own, having paid nothing out of your own pocket on closing day. This is how people with average incomes and minimal savings are buying homes right now, today. But before you get too excited, we need a dose of reality. These programs are amazing, but they aren't a free-for-all. They have rules. Most DPA programs have income limits, meaning you can't be a high earner. They are designed to help low to moderate income households. They often have credit score minimums, though they can be more flexible than traditional loans. Many require you to take a homebuyer education course, usually an online class that takes a few hours but provides a ton of value. And most importantly, many of these programs are location-specific. A program available in one county might not be available in the one next door. They can also be tied to specific professions, like teachers, firefighters, or first responders. The point is, you have to do your homework. These programs are like hidden treasure chests, but you need the map to find them. And that's exactly the problem we're going to solve. You now know that these incredible tools, grants, forgivable loans, and gift funds exist. You know it's possible to get into a home with little to no money of your own. But how do you find the specific programs available to you right where you live? Where is the website? Who do you call? In the next part, we are pulling back the curtain and giving you the exact playbook, the step-by-step guide to locating every single down payment assistance program in your state, your county, and your city. You won't want to miss it. Alright, the playbook is open. Forget aimlessly Googling down payment help and getting buried under an avalanche of ads and misinformation. We're going to build your search strategy from the ground up, starting with the most powerful official resources and drilling down with surgical precision. This is the exact method pro loan officers and real estate agents use to find options for their clients. Your first stop, your ground zero, is not a bank. It's not Zillow. It's the U.S. Department of Housing and Urban Development, or HUD. Think of the HUD website as the Library of Congress for housing assistance. It's a bit old school, a little clunky, but it is the definitive source. You're going to search for HUD state and local homebuyer programs. This will lead you to a page with a map of the United States. Click on your state, and you'll get a list of government-approved, legitimate programs operating where you live. This isn't a comprehensive, real-time list of every single program, but it's your first, most important step. It validates that these programs are real, and it gives you the official names of the organizations running them. This is your first piece of intelligence. Now, take the names of those organizations you found on the HUD site. One of them will almost certainly be your state's Housing Finance Agency, or HFA. This is the single most important term you will learn in this entire process. Every state has an HFA, though they might call it something slightly different, like the Housing Development Authority, or Housing and Community Development Agency. These are quasi-governmental agencies whose entire mission is to make housing more affordable for the residents of that state. They are the gatekeepers to the biggest and best down payment assistance programs. So your second critical step is to go directly to your state's HFA website. Don't just browse it. You need to become an expert on it. Look for a tab or a link that says homebuyers, homeownership, or lenders. This is where the gold is buried. You're going to find detailed PDF documents, income limit charts, and lists of their specific down payment assistance products. Let's walk through a real-world example. Say you live in Florida. You'd search for the Florida Housing Finance Corporation. On their site, you'd look for homebuyer programs. You'd find things like the Florida Assist Loan Program or the HFA Preferred Grant. Each one will have its own rules. One might offer up to $10,000 as a silent second mortgage. Another might offer 3% of the purchase price as a non-repayable grant. The details are all there, laid out in black and white. You'll find information on income limits, which are often much higher than people think, purchase price limits, and credit score requirements. This website is your new best friend. Bookmark it, read it, understand it. But here's a pro tip, a step that 99% of aspiring homebuyers miss. Finding the program is only half the battle. You need to find the people who can actually give you the program. Not every mortgage lender, not every bank, is approved to offer these state-run assistance programs. They have to go through special training and be certified by the state's HFA. Trying to call a random lender you saw on a billboard and asking them for the California Dream for All program is like walking into a Pizza Hut and asking for a Big Mac. They'll have no idea what you're talking about, and worse, they might try to convince you that what you want doesn't exist and steer you into a loan that benefits them, not you. So on that same HFA website, you need to look for a link that says, Find a Lender, Approved Lenders, or Participating Loan Officers. This is the secret weapon. This is your curated list of experts. These are the loan officers who have been trained, vetted, and given the keys to unlock these programs for you. Don't just pick one at random. Look for lenders in your local area. Look for individuals, actual loan officer names, not just big corporate brands. These are the specialists you need to call. When you call them, you'll be having a completely different conversation. Instead of saying, "Do you have any no down payment loans?" you'll say, "I was on the state HFA website, and I'd like to know if I qualify for the insert specific program name here down payment assistance program." The difference is night and day. You've gone from a hopeful beginner to an informed, educated consumer. You're speaking their language. But we're not done. We've covered the federal and state levels. Now it's time to go micro. This is where you can often find the most generous, most impactful assistance. We're talking about county and city level programs. Many people assume that if a program exists, it would be listed on the state HFA website. That is a huge and often costly mistake. Many larger counties and municipalities receive their own separate funding from HUD and run their own independent programs with their own rules, their own income limits, and their own application processes. Your mission here is to put on your detective hat. Open a new search and type in your county name down payment assistance. For example, Maricopa County Down Payment Assistance or Cook County Homebuyer Program. You're looking for the official county government website, not a third-party ad. You might find a program that offers $20,000 in a forgivable loan specifically for first-time buyers in that county. It might be a program targeted at essential workers, like teachers, firefighters, or nurses, offering even more significant help. Then do it again for your city, and for the major cities neighboring you. City of Houston Down Payment Assistance. City of Philadelphia Homeownership Grant. You might be shocked at what you find. These hyperlocal programs are often the best-kept secrets in real estate. They don't have massive advertising budgets. Their websites might look like they were designed in 1998. But the money they provide is very, very real. Let's recap this playbook, this step-by-step action plan. Step 1. Go to the HUD website. Find your state's page to get the official names of the major housing organizations. Step 2. Identify and go directly to your state's Housing Finance Agency, HFA website. This is your primary source of truth. Step 3. On the HFA website, do 2 things. First, research the specific down payment assistance programs they offer. Second, find their list of approved lenders. This is your golden Rolodex. Step 4. Go hyperlocal. Conduct separate, targeted searches for down payment assistance programs run by your specific county and your specific city. Step 5. Now and only now do you start making calls. But you're not calling random lenders. You're calling the certified, approved loan officers from the list you found on the state HFA website. You're starting the conversation from a position of power and knowledge. By following these 5 steps, you're creating a comprehensive map of every single potential dollar of assistance available to you. You're layering the federal, state, county, and city-level opportunities on top of each other. This is how you discover you might qualify for a state-level 3% grant, which you can then combine with a city-level $10,000 silent second mortgage, suddenly turning a massive down payment problem into a manageable, or even non-existent, one. You now have the where and the how to find these programs. You have the playbook. But once you find them, what are they really? Is it just free money? Is a grant the same as a forgivable loan? What are the strings attached to a deferred payment second mortgage? Because let me tell you, there are always strings. And understanding those strings is the difference between accepting a life-changing gift and signing up for a financial nightmare. In the next part, we are going to dissect the anatomy of these assistance programs. We'll explore the 3 main types you'll encounter, reveal the hidden terms and conditions you absolutely must know about, and teach you how to choose the one that's truly right for you. So let's pull back the curtain on these down payment assistance programs, or DPAs. Think of them not as a single product but as a diverse toolkit. Each tool is designed for a slightly different job, and using the wrong one can cause some serious problems down the road. Broadly speaking, you're going to run into three main categories of assistance: grants, forgivable loans, and repayable loans. Understanding the DNA of each one is the first step to making a brilliant financial decision. Let's start with the one everyone dreams about: the grant. This is the holy grail of down payment assistance. Why? Because a grant is quite literally a gift. It's money you are given to put toward your down payment or closing costs that you never ever have to pay back. There are no strings attached in terms of repayment. It doesn't create a second payment, it doesn't accrue interest, it's just yours. Sounds too good to be true, right? Well, sort of. Grants are the rarest form of DPA for a reason. The eligibility requirements are often incredibly strict. We're talking about very specific income limits, often well below the area median income. They are almost always reserved exclusively for first-time homebuyers, and sometimes they're even targeted to specific professions, like teachers, firefighters, or first responders, or for homes in designated revitalization areas. The biggest catch, however, can be in the fine print of your primary mortgage. Some lenders who facilitate these grants might offer you a slightly higher interest rate on your main home loan than you could get otherwise. They have to make their money somewhere. So, while you're getting free money up front, you might be paying a little extra for it every single month for the next 30 years. It's a trade-off you have to calculate. But if you can find one and you qualify, a true grant is the undisputed champion of DPA. Now, let's move on to the most common and perhaps most misunderstood category: the forgivable loan. This is a bit of a hybrid, and it's where the details become absolutely critical. On the surface, it looks like a loan. It's technically a second mortgage or a subordinate lien that's placed on your property right behind your main mortgage. You'll sign papers for it at closing, and it will show up on your title report. But here's the magic. You typically don't have to make any monthly payments on it. Instead, the loan is forgiven over a set period of time, as long as you abide by the rules. The number one rule is almost always a residency requirement. The organization giving you the loan wants to encourage neighborhood stability. They're investing in you and, by extension, the community. So they'll say something like, "We'll give you $10,000 for your down payment as a forgivable loan. For every year you live in this house as your primary residence, we will forgive 20% of that loan." Let's break that down with a real-world example. You get a $10,000 DPA on a 5-year forgiveness schedule. After you've lived in the home for 1 full year, $2,000 of that loan vanishes. Poof, gone. You now only owe $8,000. After year 2, another $2,000 is forgiven. You owe $6,000. This continues until the end of year 5. Once you hit that 5-year anniversary, the final $2,000 is forgiven, the entire $10,000 loan is wiped out, and the lien is removed from your property. You met your end of the bargain, and the loan has effectively turned into a grant. It's an incredible deal for someone who plans to stay put. But what happens if life happens? What if you get a dream job offer in another state 3 years into your 5-year term? This is the gotcha moment. When you sell the house, you haven't met the full terms. You lived there for 3 years, so 60% of the loan, $6,000, has been forgiven. But that remaining 40%, the other $4,000, has to be paid back. Typically, it will be paid directly from the proceeds of your home sale at closing. So it's not a disaster, but it's a crucial detail. If you think there's a strong chance you'll move within a few years, a forgivable loan might not be your best friend. Finally, we have the third and most straightforward category, the repayable loan. Just like the forgivable loan, this is also a second mortgage. The key difference is that there's no forgiveness. You are borrowing the money and you have to pay it back. But how you pay it back can vary. The most popular version is called a deferred payment loan. With this setup, you get the DPA funds for your down payment, and you don't have to make any monthly payments on it. The loan just sits there silently. It's like an interest-free loan from a very patient family member. The payment is deferred, or postponed, until a specific trigger event occurs. What's a trigger event? The 3 most common are: 1. You sell the property. 2. You refinance your primary mortgage. Or 3. You pay off your primary mortgage in full. When any of those things happen, the entire DPA loan becomes due as a single balloon payment. This is a fantastic option for managing monthly cash flow, since it doesn't add another bill to your budget. The downside is that you have to remember that this debt exists. When you sell your house in 10 years, you'll have to pay back that $5,000, $10,000, or $15,000 from your profits before you see a dime. The other type of repayable loan is a simple, low-interest installment loan. In this scenario, you get your DPA funds at closing, and 1 month later you start making payments on it. You'll have your main mortgage payment, your PITI, and you'll have a second, much smaller payment for your DPA loan. These loans often have very favorable terms like a 1 or 2% interest rate stretched over 10 years. The monthly payment might only be $50 or $100. The advantage here is transparency. You know exactly what you owe, and you're actively paying it down. The disadvantage is that it does increase your total monthly housing expense and your overall debt-to-income ratio, which could affect how much house you qualify for in the first place. So you've got the three main structures: grants, forgivable loans, and repayable loans. But buried within the agreements for all of these are hidden terms and conditions you absolutely have to understand. These are the tripwires. One we already touched on is the recapture clause in forgivable loans. Sell too soon and you have to pay it back. But there are others. Almost every single DPA program in existence will require the home to be your primary residence. You cannot use these funds to buy an investment property or a vacation home. If you move out and turn it into a rental before the loan terms are met, you could trigger an immediate repayment clause. Another huge one, as I mentioned with grants, is the impact on your interest rate. Always ask the lender, if I don't take this assistance, what interest rate could I get on my mortgage? And what is the rate with the assistance? Then do the math. A $10,000 grant is amazing, but if it costs you an extra $150 a month for 30 years because of a higher rate, you'll end up paying $54,000 for that free $10,000. Sometimes it's still worth it to get in the door, but you must go in with your eyes open. And finally, be aware of the process itself. Most DPA programs, especially those run by state or local housing authorities, require you to work with one of their approved, certified lenders. You can't just walk into your local credit union and ask for the state's DPA program. You have to use a loan officer who has been trained on that specific program's guidelines. On top of that, many programs will mandate that you complete a certified homebuyer education course. This can be an 8-hour online or in-person class. It's actually incredibly valuable, but it's another hoop you have to jump through. Choosing the right one comes down to an honest assessment of your future. If you know deep down that this is your forever home and you'll be there for at least a decade, a 5 or 10-year forgivable loan is basically a grant waiting to happen. It's a perfect fit. If you're in a career where you might need to relocate in 3 to 5 years, that same forgivable loan is a risk. A deferred repayable loan might be a safer bet, since you know you'll just pay it back out of the sale proceeds anyway. If your absolute top priority is the lowest possible monthly payment, you need to hunt for a true grant or a deferred loan, steering clear of anything that adds another monthly bill. It's a strategic decision, not just a grab for cash. You have to match the tool to your own life's blueprint. And that blueprint isn't just about your income or your credit score. In many ways, the most important number on your blueprint is your zip code. We've talked about the big national programs, the VA, the USDA, the FHA framework. But beneath that federal umbrella exists a massive, sprawling, and criminally overlooked ecosystem of financial aid. This is where the real treasure hunt begins. We're talking about state, county, and even city-specific programs that can hand you thousands, sometimes tens of thousands of dollars for your down payment and closing costs. Most people never even think to look here. They assume the big national loans are the only game in town. They're wrong. They're leaving an incredible amount of free money on the table simply because they don't know where to dig. So, where do you begin this treasure hunt? You start at the state level. Every single state has what's called a Housing Finance Agency, or HFA. Think of it as your state's dedicated department for making homeownership more affordable for its residents. Their entire mission is to create programs that help people like you buy a home within that state's borders. And almost universally, their flagship offerings are down payment and closing cost assistance programs. These aren't some obscure, impossible-to-get funds. They are well-established, well-funded programs waiting for qualified applicants. For example, you might find a program called the Golden State Dream for All in California, or the My First Texas Home program in Texas. The names change, but the core function is often the same. They partner with approved lenders to offer you a special package deal. Typically, it involves a 30-year fixed-rate mortgage, often an FHA or conventional loan, but it's paired with a second loan or a grant to cover your upfront costs. This is where you have to put on your detective hat and remember what we talked about before. Is the assistance a grant that's fully forgiven? Is it a zero-interest, deferred loan that you only pay back when you sell the house? Or is it a second mortgage that requires its own monthly payment? Each state's HFA will have different flavors of these programs. Some states might offer a grant of up to 4% of the home's purchase price. On a $300,000 home, that's $12,000 you never have to pay back. Other states might offer a deferred loan of, say, $15,000. That's $15,000 you can use right now, interest-free. That only comes due a decade or two down the line when you sell the property and have likely built up significant equity. Now, these programs do have rules. This isn't just a free-for-all. The most common requirements are income limits. You usually have to be under the area's median income, and you often have to be a first-time homebuyer. Though, remember, the government's definition of a first-time homebuyer is often someone who hasn't owned a primary residence in the last 3 years. So even if you owned a home in the past, you might still qualify. The other major requirement is education. Most state programs will require you to complete a certified homebuyer education course. Don't roll your eyes at this. These courses are often online, relatively inexpensive, and genuinely packed with valuable information that will make you a smarter, more confident homeowner. It's a small hoop to jump through for a 5-figure check. So your first step is simple. Open a new tab right now and search for your state's name housing finance agency. Go to their website. Look for a link that says homebuyers, homeownership, or down payment assistance. You will find the map to your state's treasure right there. But we can go deeper. We can get hyperlocal. Because while state programs are fantastic, the city or county you live in might have its own, even more generous programs. This is the stuff almost nobody knows about. Cities want to attract new residents. They want to revitalize certain neighborhoods. They want to help essential workers like teachers, firefighters, and nurses buy homes in the communities they serve. And how do they do that? By offering targeted down payment assistance. You might discover that your city has a program that offers a $20,000 forgivable loan if you buy a home in a specific revitalization district. The terms might be that for every year you live in the home as your primary residence, 20% of that loan is forgiven. After 5 years, poof, the entire $20,000 disappears. You never have to pay it back. It's one of the most powerful wealth-building tools imaginable, and it's hiding in plain sight on a government website that looks like it was designed in 1998. I know a story about a young couple in Baltimore. They were saving up, doing everything right, but the down payment was this massive wall they couldn't seem to climb. Someone told them to check the city's housing website. They found a program called Buying into Baltimore that offered a $5,000 grant. Then they found another program for city employees. One of them worked for the public school system. That was worth another $5,000. And on top of that, they qualified for a state-level deferred loan. They stacked all three. They walked into their first home with almost no money out of their own pocket. Their entire financial future was changed not by some Wall Street wizardry, but by a couple of hours spent on a local government website. This is why your location is so critical. The opportunities available to someone in Denver, Colorado are completely different from those available to someone in Orlando, Florida. You have to do the local legwork. The search is just as simple. Google your city name down payment assistance or your county name housing authority. You might be absolutely shocked at what you find. I know this can sound a bit overwhelming. Feels like homework. You're navigating these clunky websites, reading through program guidelines filled with jargon. It's easy to get frustrated and just give up. But I want you to reframe this. How much do you get paid per hour at your job? $20? $50? $100? If you spend 5 hours digging through these websites and it nets you a $15,000 grant, you just paid yourself $3,000 per hour. There is no job on earth that has that kind of return on investment. This research isn't a chore. It's the single most profitable work you can do for your family's future. The key to navigating all of this is finding the right guide. While you can do the initial research yourself, the ultimate pro tip is to find a local mortgage lender who specializes in these programs. Not just any lender. Not the person from the big national bank in the TV commercial. You need to find a loan officer who, when you say the name of your state's HFA program, doesn't give you a blank stare. They should say, "Oh yeah, I've closed dozens of those. Here's what you need to know." These lenders are the gatekeepers. They are approved to work with these state and city agencies. They know the paperwork inside and out, and they can help you layer and stack different programs to maximize your benefit. Finding that lender is as important as finding the right house. So you've got the power of the federal government with VA and USDA loans. And now you have this hidden network of state and local programs that can hand you the cash you need. You're building a powerful toolkit. But what if the treasure isn't buried by the government, but by the banks themselves? What if the very institutions you're borrowing from have their own secret, no-down payment programs designed to compete with all of these government options? They absolutely do. And they represent one of the most overlooked and powerful corners of the mortgage universe. Welcome to the world of proprietary loans, the custom-built, off-menu options that banks and credit unions create to win your business. Think about it from their perspective. The government has the VA loan, the USDA loan, and the FHA program. These are massive, federally backed products. How does a regional bank or a local credit union compete with the full faith and credit of the United States government? They can't win on security, so they have to win on creativity. They have to build a better mousetrap. They do this by identifying specific, highly desirable customers and creating a loan product so perfectly tailored to their needs that it's an offer they can't refuse. And the most classic, most powerful example of this is the doctor loan. For decades, banks have looked at newly graduated doctors, dentists, and veterinarians and seen a paradox. Here is a person who is about to become one of the highest-earning professionals in the country. They are an A-plus blue-chip financial bet for the next 30 years. But right now, they have almost no savings, and they're carrying a mountain of student loan debt that would make a conventional loan underwriter run screaming from the room. A standard debt-to-income calculation would disqualify them instantly. So the banks created a solution. The doctor loan. It's a special type of portfolio loan, meaning the bank keeps it on its own books instead of selling it. And its features are designed to solve every single problem a new doctor faces. First, and most importantly for our conversation, they often require 0% down, 100% financing, no down payment needed. Second, they almost never have private mortgage insurance or PMI. This is a huge deal. The bank is so confident in your future earnings that they waive the insurance requirement, saving you hundreds of dollars every single month. But here's the real magic. They completely change how they calculate your student loan debt. Where a conventional loan might see 6 figures of student debt and assign a punishing monthly payment to it for qualification purposes, a doctor loan program understands the reality of income-based repayment plans. They will often use your actual monthly payment, even if it's 0 or a much more forgiving calculation. They're not just looking at your financial snapshot today. They're underwriting your entire career trajectory. They are playing the long game. They give you a 0-down mortgage now because they want you as a wealthy client for life. And it's not just for medical doctors anymore. These professional loans have expanded. Many lenders now offer similar programs to dentists, optometrists, veterinarians, pharmacists, and sometimes even attorneys, CPAs, or airline pilots. The principle is the same. Find a profession with a high, stable, and predictable future income, and remove the early career barriers to homeownership. But what if you're not a doctor or a lawyer? Are you just locked out of these private 0-down options? Not at all. This is where the treasure hunt gets even more interesting. Banks don't just target high-income professions. They also target specific communities. Many large, national banks have what are called Community Reinvestment Act goals, or CRAs. It's a regulatory framework that encourages them to lend in low to moderate income neighborhoods. To meet these goals, they've created their own proprietary grant programs. One of the nation's largest banks, for example, currently offers a program that provides up to $10,000 for a down payment and another $7,500 for closing costs. That's a $17,500 grant. It's not a loan, you don't pay it back. On a $300,000 home, that grant is nearly 6% of the purchase price, more than enough to cover a conventional down payment and all your costs. It effectively turns a low down payment loan into a no-cost loan. The only catch? It's typically only available in specific pre-approved census tracts, usually in majority-minority neighborhoods or areas the bank wants to help revitalize. This is a powerful targeted strategy, and it means the exact same house on one side of the street might not qualify while the house directly across from it does. The key is knowing that these programs exist and asking about them. Beyond the big national banks, the real secret weapon for finding these loans is your local credit union. Credit unions are nonprofits owned by their members. Their mission isn't to maximize shareholder profit. It's to serve their community. And because of that, they often have the most flexible and generous programs you'll find anywhere. You might find a local teachers' credit union that offers a 100% financing option specifically for educators in the district, or a credit union for first responders that does the same. These programs are rarely advertised on national TV. You won't see them in a Super Bowl commercial. They are hyper-local, designed for the people right there in that town, that county, that profession. It's relationship-based banking at its finest. So how on earth do you find these hidden gems? You have to become a detective. First, you need to talk to a mortgage broker, not just a loan officer at a single bank. A loan officer at Big Bank USA can only sell you products from Big Bank USA. A mortgage broker, on the other hand, works with dozens of different lenders, big banks, small banks, credit unions, and wholesale lenders you've never even heard of. They are the ones who know that Lender X has a great doctor loan program, but Credit Union Y has a zero-down community loan for the specific neighborhood you're looking at. They are your professional treasure map. Second, you have to go hyper-local yourself. Make a list of every community bank and credit union in the area where you want to buy. Go to their websites. Don't just look at the homepage. Dig into the mortgage or home lending sections. Look for links that say community programs, first-time homebuyers, or affordable housing. Many of these programs are buried, but they are there. And don't be afraid to pick up the phone. Call them and ask a very specific question. Which brings us to the third and most important step. You have to ask the right questions. When you talk to any lender, broker, or bank, don't just ask, "What's your best interest rate?" That's the amateur question. The pro asks a different set of questions. Do you offer any proprietary 100% financing loans? Do you have any portfolio loans for professionals in my field? Are there any grant programs or community-focused loans available for this specific address or zip code? What are my options for a loan with no private mortgage insurance? Using this language signals that you've done your homework. It forces the lender to look beyond their standard vanilla 30-year fixed-rate mortgage and dig into the special programs that could actually change the game for you. Now, are there catches? Of course. Proprietary loans are not a magic wand, because the bank is taking on more risk by keeping the loan on its own books and requiring no down payment. They might compensate in other ways. The interest rate might be 1/4 or 0.5% higher than a standard conventional loan. The credit score requirements might be stricter. The program might have an income cap, or be geographically restricted to a few specific counties. But you have to do the math. A slightly higher interest rate can be a tiny price to pay for a loan that allows you to buy a home now instead of waiting 5 more years to save a down payment, while home prices and rents continue to rise. A loan that saves you $300 a month by eliminating PMI is a fantastic deal, even if the rate is a little higher. The best loan isn't just the one with the lowest rate. The best loan is the one that gets you into a home you love, in a financially responsible way that works for your specific situation. We've covered a massive amount of ground. We've looked at the government superhighways, the VA and USDA loans. We've navigated the standard routes of FHA and conventional loans. We've uncovered the treasure chest of down payment assistance. And now we've explored the secret private backroads that the banks build for themselves. We've filled almost the entire map. But there's one area left to explore: the uncharted territory. What happens when none of these options work? What if you need to go completely off-road and forge your own path? What if the key to your new home isn't in a bank at all, but in the hands of the person selling it? This is the world of seller financing. And for the right person in the right situation, it can feel like finding a secret passage when every main door is locked. Forget the bank. Forget the underwriters. Forget the rigid boxes you've been trying to fit into. In this scenario, the seller becomes your bank. You're not applying for a loan. You're entering into a private agreement. You make your monthly payments not to a massive, faceless corporation, but directly to the person who just handed you the keys. Now, the first question that should be screaming in your head is, why? Why on earth would a seller agree to this? Why would they take on the risk of a buyer defaulting? And why would they wait years, sometimes decades, to get all of their money? The answer isn't simple, because human motivation rarely is. But it usually boils down to a few key factors. First, a wider pool of buyers. A seller who offers financing isn't just selling to people who can walk into a bank and get approved. They're opening the door to entrepreneurs, freelancers with fluctuating income, recent graduates with thin credit files, or people who just had a temporary financial setback. By offering to be the bank, they make their property available to a huge, untapped market, which can often lead to a faster sale and even a higher sales price. Second, it's a source of passive income. Instead of getting a single lump sum of cash, the seller receives a steady stream of monthly payments, plus interest for years to come. For a retiree, this can be an incredibly attractive alternative to the volatility of the stock market. They're not just selling a house, they're creating their own private annuity, secured by a piece of property they know intimately. Third, there can be significant tax advantages. By receiving the payment for their home over many years as an installment sale, sellers can often spread out their capital gains tax liability instead of taking a massive tax hit all in one year. It's a strategic financial move. And finally, sometimes it's just about solving a problem. Maybe the property is unique: a dome home, a property with extensive farmland, a multi-unit building that traditional lenders are hesitant to finance. By offering financing, the seller removes the biggest obstacle for a potential buyer. So, for the buyer, for you, this opens up a universe of possibilities. The biggest, of course, is the down payment. Since you're not dealing with federally mandated lending rules, the down payment is 100% negotiable. Can you get a zero-down deal with seller financing? Absolutely. If you can convince the seller that you are a reliable, trustworthy person who will care for their former home and make every payment on time, they can write the deal any way you both agree. The terms are a blank slate: your credit score, your debt-to-income ratio, your employment history. While the seller will almost certainly want to vet you, they aren't bound by the same rigid underwriting rules as a bank. There's room for explanation, for nuance, for your personal story to matter. Closing can also be lightning fast. You're cutting out the entire mortgage underwriting department. There are no loan committees, no final reviews from a mysterious figure in a corporate office 3 states away. It's an agreement between you, the seller, and your respective attorneys. This can shave weeks, even months, off the closing process. And because you're not paying for bank origination fees, application fees, and a host of other lender-specific charges, your closing costs can be significantly lower. But this is the uncharted territory we talked about. And here be dragons. This path is not for the timid or the unprepared, because the flexibility that makes seller financing so attractive is also what makes it potentially dangerous. The number one risk is that sellers are not your friends. They are business people looking out for their own interests. They will almost always charge a higher interest rate than a traditional bank to compensate for the risk they're taking. Don't be surprised to see rates a few percentage points higher than the going market rate. That's the price of admission. The second, and arguably most critical danger, is something called a due-on-sale clause. If the seller still has an existing mortgage on the property, their loan agreement almost certainly contains this clause. It means that the moment the title of the property is transferred to someone else, to you, the seller's lender has the right to call the entire remaining balance of their loan due immediately. If that happens, your entire seller financing agreement is worthless, and the seller has to pay off their bank in full, which usually means the sale collapses, potentially after you've already moved in. This is a catastrophic failure point, and it's why you must have an attorney verify that the seller owns the property free and clear, or that their lender has explicitly given permission for the arrangement. Do not, under any circumstances, take the seller's word for it. Then there's the structure of the loan itself. Many seller finance deals include a balloon payment. This means you'll have smaller, manageable monthly payments for a short period, say 3, 5, or 7 years. But at the end of that term, the entire remaining loan balance becomes due in one single massive payment. The seller isn't planning on being your bank for 30 years. The idea is that this arrangement gives you a few years to live in the home, build equity, and improve your financial situation so that you can then qualify for a traditional mortgage and refinance the property, paying the seller off in full. But if you can't get that new loan when the balloon payment is due, you could lose the house and every dollar you've put into it. It's a ticking clock, and you need to have a rock-solid plan to defuse it from day one. So how do you even find these deals? You have to hunt. They are rarely listed on the big real estate websites with a seller financing available checkbox. You start by looking for properties that are for sale by owner, or FSBO. Owners who are already cutting out the real estate agent might be more open to cutting out the bank, too. Look for listings that have been on the market for a long time, or for properties owned by retirees looking to downsize. In your online searches, use keywords like owner will carry, contract for deed, or seller will finance. But the most effective method is simply to ask. Find a home you love. Write a compelling personal letter to the owner. Introduce yourself, explain your situation honestly, and present a professional proposal. The worst they can say is no. But you might just be the exact solution they were looking for. If you do find a willing seller, you cannot do this on a handshake. You cannot use a boilerplate form you found online. You must, and I cannot stress this enough, hire a qualified real estate attorney who specializes in this type of creative financing. They will draft 2 critical documents. A promissory note, which is your official IOU that details the loan amount, interest rate, payment schedule, and what happens if you're late. and second, a mortgage or deed of trust, which is the document that gets recorded publicly and secures the loan against the property. It's what gives the seller the right to foreclose if you stop paying. This legal framework is your only protection. It protects you from a seller changing their mind, and it protects them if you default. It is the single most important part of the entire process. We've covered the government-backed superhighways, the down payment assistance on-ramps, and now the creative financing backroads. We have explored the vehicles that can get you to the destination of homeownership. But none of it matters if you don't know how to drive. Before you even put the key in the ignition, before you make a single call or look at a single listing, there is one final critical system check you must perform. It's the one thing that separates the people who successfully buy a home with no money down from those who just keep dreaming about it. It's not a loan or a program. It's a strategy. And it's the last piece of the puzzle we need to put in place. This strategy is called the stack. Think of it like building a financial sandwich. You don't just use one ingredient. You layer multiple elements on top of each other until you have a complete meal. Or in this case, a complete home purchase with little to no money out of your own pocket. This is how you transform a low down payment loan into a true zero down, zero closing cost reality. Let's break it down layer by layer. The first layer, the foundation of our stack, is your primary mortgage. If you're eligible, this is your VA loan or your USDA loan. They are true zero down loans right out of the box. But for the millions of Americans who don't qualify for those, the foundation is a low down payment loan. We're talking about the FHA loan, which requires just 3.5% down, or a conventional 97 loan, which requires only 3% down. For most people, this is where the journey ends. They see that 3.5% and think, well, on a $300,000 house, that's $10,500. I don't have that. And they give up. But for us, this is just the beginning. This is just the bread. Now we add the second layer, down payment assistance or DPA. This is the ingredient that specifically targets and eliminates that initial down payment. We touched on these programs before, but now we're putting them into the context of our strategy. DPA programs are typically offered by state or local housing finance agencies. They come in two main flavors: grants, which are free money you don't have to pay back, and silent second mortgages. These silent seconds are loans that cover your down payment, but you often don't have to make any payments on them. Sometimes they're forgiven completely after you've lived in the home for a certain number of years, say 5 years. Other times, you only have to pay them back when you sell the house or refinance. So you go to your state's housing authority website. You find a DPA program that offers a 4% grant. You apply that to your FHA loan on that same $300,000 house. Your 3.5% down payment, that $10,500, is now completely covered. In fact, you have a little left over. Suddenly, your FHA loan functions just like a zero-down loan. You've successfully stacked a DPA program on top of your primary mortgage to eliminate the down payment. But here's where most people get tripped up again. They celebrate getting the down payment covered, only to be blindsided by the other mountain they have to climb: closing costs. Closing costs are all the fees associated with finalizing the mortgage, appraisal fees, title insurance, attorney fees, loan origination fees. They typically range from 2% to 6% of the purchase price. On our $300,000 house, that could be anywhere from $6,000 to $18,000. It's a massive, unexpected expense that shatters the homeownership dream for so many. This is where our final, most critical layers come into play. The third layer of the stack is seller concessions. This is pure negotiation, and it's an art form. Seller concessions are when you, the buyer, ask the seller to contribute a certain amount of money towards your closing costs. Now you might be thinking, why on earth would a seller agree to pay for my fees? The answer is simple. It's all about the net price. Let's go back to our $300,000 house. You know you need, let's say, $9,000 to cover your closing costs. So instead of offering the seller $300,000, your real estate agent crafts a more strategic offer. You offer $309,000 for the house, but you ask the seller for $9,000 back in concessions at closing. Look at the math from the seller's perspective. In both scenarios, they walk away with the exact same amount of money, $300,000. It makes no difference to their bottom line. But for you, it's a world of difference. You've just rolled your closing costs into your loan amount, effectively financing them instead of paying for them out of pocket. The seller gets their price, and you get to walk into your home with thousands of dollars still in your bank account. Every loan type has limits on how much a seller can contribute. For FHA, it's up to 6% of the purchase price. but it is one of the most powerful and underutilized tools for a no-money down purchase. But what if the seller says no? What if you're in a competitive market and you can't negotiate concessions? We have one final layer. The secret weapon. The fourth and final layer of the stack is a lender credit. This is a conversation you have directly with your mortgage lender. It works like this. The lender can offer you a credit to be used towards your closing costs. In exchange, you agree to a slightly higher interest rate on your loan. Essentially, you're trading a higher monthly payment over the life of the loan for the immediate benefit of not having to bring cash to the closing table. Let's say your closing costs are $5,000. The lender might say, "We can give you a $5,000 credit to cover that, but your interest rate will go from 6.5% to 6.875%. Your monthly payment might be $50 or $60 higher. But for someone who simply does not have that $5,000 in savings, this is the key that unlocks the door. It's the final bridge. And remember, you're not stuck with that higher rate forever. Down the road, when your financial situation improves and rates are favorable, you can always refinance into a lower rate. The lender credit is a short-term solution for a long-term goal. So let's put it all together. Let's see the stack in action with a real-world scenario. Meet Sarah. Sarah is a graphic designer living in a major city. She has a good job and a solid credit score, but with student loans and the high cost of living, she's been unable to save a large lump sum for a down payment. She wants to buy a condo for $250,000. First, Sarah's lender gets her pre-approved for an FHA loan. The down payment is 3.5%, which is $8,750. Her estimated closing costs are 4%, which is another $10,000. All in, she needs $18,750 in cash. Feels impossible, but Sarah is strategic. She doesn't give up. She starts with layer 2. She researches her state's housing programs and finds a DPA that offers a forgivable second mortgage for up to 5% of the purchase price. She applies and is approved. That 5% gives her $12,500. This completely covers her $8,750 down payment, and she even has $3,750 left over to apply towards her closing costs. Her total cash needed has just dropped from over $18,000 to just $6,250. It's better, but still a stretch. Now for layer 3. Sarah and her real estate agent find the perfect condo. It's listed for $250,000. They structure an offer for $255,000 and ask for $5,000 in seller concessions. The seller accepts because they're still netting their full asking price. That $5,000 is applied directly to Sarah's remaining closing costs. Now, the amount she needs to bring to closing is just $1,250. We've gone from $18,000 to just over $1,000. This is the power of the stack. For that final amount, Sarah could easily use a small lender credit or simply pay it from her next paycheck. She can walk into her new home having spent almost none of her savings, keeping her cash reserve for moving expenses, new furniture, and that all-important emergency fund. This isn't a loophole or a gimmick. This is a legitimate, intelligent strategy used by savvy homebuyers across the country. It requires a proactive mindset. It requires you to do your homework. It requires you to build a great team, a loan officer and a real estate agent who are experts in these programs and negotiation tactics. The idea that you need to save for 10 years to scrape together a 20% down payment is an outdated myth that keeps far too many people renting. Homeownership is the single greatest wealth-building tool for the average American. It's forced savings, it's a hedge against inflation, and it's a foundation for your financial future. And the barrier to entry is not as high as you've been led to believe. From the ironclad promise of a VA loan for our veterans, to the rural opportunity of a USDA loan, to the powerful multi-layered strategy of the stack, the path is there. It's not a single straight line. It's a custom-built road you pave yourself, one strategic layer at a time. The question is no longer if you can buy a home with no money down. The only question left is, when will you start building your plan?